Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull, and I appreciate you being with us. This segment is brought to you by my company, Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com or contact me directly, michael@bullrealty.com. Well, today we're going to talk about debt financing. You know, it's been some big changes going on, obviously, in the debt world. We're going to have a lot of maturities coming up. Then borrowers, property owners are going to have to pay higher rates. Well, what's going on with loan-to-value ratios? What's going on with underwriting? What might we expect for distress coming from some of this? What about negative leverage? Are people doing it? How's it working? Well, I have an expert here for you today. Please welcome Tom Walsh, and he's with Grandbridge, and he speaks on the mortgage market, debt market for many years around the country and around Atlanta, and I've always enjoyed hearing you speak. And I kind of want to start there. I mean, you've been in this business for what, 39 years?
Yeah.
And you know, a lot of folks, even in my shop, have only been in business like 10 years. And they've seen these incredibly low rates. How do rates today really kind of stack up when you think of kind of historically what rates have been?
From a historical perspective, rates are kind of in the normal range right now. Historically, rates that start with fives or sixes are relatively normal. We got very, very spoiled over the last 2 to 3 years where rates that started with a 3 were the norm. And you can get used to that very quickly.
Yeah.
And that kind of becomes your norm. But if you look over history, where we are right now is fairly typical. Where what's different today is the relationship between those rates and the cap rates that the property's valued at. That is an unprecedented relationship right now. And in some cases, especially if you look at multifamily or industrial, we're seeing interest rate constants that are 300 basis points higher than the cap rates on properties. That's the definition of negative leverage is your debt constant higher than your cap rate. And it's even if it's only 25 basis points, that's considered negative leverage. And what that means generally is leverage is not enhancing your returns. It has a negative impact on your returns. The more money you borrow, the less your return is on your equity.
Right.
And right now that is so negative that we're seeing it certainly impacting things. However, it's not eliminated transactions, and it doesn't imply that a deal, because you do a deal with negative leverage, doesn't imply it's a bad deal at all, because there are certainly other factors that are going on in how you evaluate the long-term feasibility of a deal. But this level of negative with leverage is, in my career, unprecedented.
Yeah, I mean, that's a good point. I've been in business for a long time, and I remember when we got 12% interest rates, we're like excited. Wow, that's so great. It's like, and then I've had negative leverage on properties that I've owned that I did really well on. It's like we need to remember those days that we're not just buying it for the next 12 months. And again, to your point, negative leverage doesn't mean it's negative cash flow either.
No, it doesn't mean that. And negative leverage could almost imply in some cases that maybe you're getting a better deal, because negative leverage impacts valuations. And it might there might be a delay until it does, but it certainly does impact valuations. Right. And we're starting to see in some segments right now valuations starting to drop. I'm sure you're seeing that in your business. And so that negative leverage, the existence of the negative leverage might be allowing you to get something at a better price than you otherwise would.
Yeah.
So it's not all bad.
Right. But obviously there's maybe less buyer competition, right?
Yes.
And you're potentially getting it at a lower price per square foot.
Sure.
So like I know I own some properties I've owned for a very long time, and the fact that what interest rates I got on them at the time almost doesn't matter at this point.
No, it doesn't. No. It's the relationship between your rate and your cash flow.
Right.
What happened yesterday doesn't really count.
Right.
All
right.
So.
And where are we on loan to value ratios and underwriting today compared to kind of historically and then prior to this big increase?
Sure. The underwriting today, in almost all cases, is debt coverage driven, or debt yield driven, depending on what your lender type is, and that is a change from what we've experienced in recent years, where rates were so low, debt coverage just took care of itself.
Right.
You calculated, but you knew it was going to be high. You weren't really worried about it at all.
Yeah.
With the switch in rates now, debt coverage is now what everyone is using. And depending on your property type, your lender or whatnot, it's going to be a minimum of 1.25, maybe it's 1.35, could be 1.5, but it's in that range there as far as the lowest you can go. And today, in the more favorable your property type, the lower your loan to value is going to be, because the more favorable property types have lower cap rates.
Right.
So sometimes today we'll calculate a 1.25 debt cover on a deal using very ABC easy underwriting on a deal, and that might translate to 55% loan. Mm-hmm. You get a really high-end apartment deal, it might translate to 48% loan. Mm-hmm. And that's an interesting situation. In another one we really haven't seen, where a 50% down payment is not just a good thing, it's required by your underwriting. Right. And that's taken some getting used to over the last 12, 18 months for people. But that's kind of the norm right now. The oddly enough, the what we might call the lesser desirable property types, as you move down the scale, because the cap rates are higher for those, you might actually be able to borrow a little more money on those, which seems very counterintuitive.
Yeah, it does.
I should be able to borrow more money on a retail property than on a multifamily property.
Right.
But it's a math. The math is indicating that in a lot of cases today.
Yeah, like you said, it's the debt coverage ratio that the lender's concerned about. And speaking of lenders, of the various types of lenders like life insurance, Fannie, banks, who's active where? Because we're hearing that some lenders are like, we're holding off a little bit.
Sure, that's out there. Fannie, Freddie, and HUD are going like normal, I would say. They both are going to go into 2023 with big appetites, and we'll be looking to do a significant amount of business. Fannie and Freddie will be, as they have been the last few years, still focused primarily on properties that have an affordable rents, and that doesn't have to be like it has tax credits and rent restrictions. It can just be a property that by nature of where it's located gives you relatively affordable housing in that market. They'll focus on that. They'll end up probably doing about 50% of their business in that affordable space, and then 50% of what we call market rate. But they'll both have big appetites going into the year, and HUD is very, very consistent in that. They speed up and slow down based on time frame of processing, but their appetite is very consistent. Life insurance companies right now, it's kind of it's fairly binary right now. You have people who are in the market like they normally are. You have people that are either very, very slow or out of the market. Sometimes because of what's going on in the real estate market, and they're trying to take a wait and see approach. A lot of that on the life company side is they did so much business in the first half of 2022. A lot of them go on allocations, right, and they used up so much of their allocations in the first part of this year that they're kind of on the sidelines. Now, the lenders in that situation, though, they should be ready to go when January 1st gets here as far as closings.
Right.
On the CMBS side, things are just slow on CMBS. The rates there are higher than the rates are where you would find in life insurance companies, banks, Fannie, Freddie. So it's hard to get deals to work there. Their floating rate deals all require a debt service cap or interest rate cap. And those are very expensive right now because of volatility in the market right now. So that business is slow without a doubt. A lot of the CMBS deals that get done these days are what we call SASBs, which is single asset or single borrower. It's not the old fashioned I do 25 loans and make them into a pool type of thing. Mm-hmm. I'll do one borrower's portfolio, or I'll do a office building in Manhattan for $500 million, and we'll securitize that one loan. That's a lot of what CMBS is doing now. On the debt fund side, they're a little bit of a similar CMBS thing. The interest rate market with SOFR sitting as high as it is right now, a lot of your even what you would call a favorable spread on a bridge loan could put your note rate in the 7s easily, even into the 8s in some cases. So obviously the demand for money at those rates has dropped significantly. You also have the interest rate cap costs involved with those that have gone up quite a bit. So they've slowed down quite a bit. It's still a viable product for someone who's doing a transition, whether it's a renovation or a re-tenanting or something along that line, but they have certainly slowed. The bank situation's kind of interesting. There's been a noticeable slowdown in the large banks, the 4 money center banks and the super regionals, noticeable slowdown in commercial real estate lending on purpose with that. As to how that goes going into next year, I think that still remains to be seen. At the local level, the community bank level and the smaller banks, we find a fair amount of them still active. If they can get the deals to work, that's the hard thing today is the underwriting and getting a deal to work to the borrower's satisfaction.
Yeah. Well, it seems like a really good opportunity for some of those smaller banks to build relationships.
Sure.
Right, and maybe some of the safest loans ever because the prices per square foot may be cheaper and the debt coverage ratio is strong.
It kind of harkens back, 2009, when we just started kind of coming off the bottom in the Great Recession. It was probably the best loans you'd ever make in your entire life, and hardly anybody was making loans.
Right, exactly. And let's talk about that for a minute. So, how does the commercial real estate market sit in your mind, being with the experience level you have, and also on the lending side, I haven't seen the distress. When you look at where we are today with commercial real estate, here we are at the end of November, beginning of December of 2022. When you compare it to like 08, 09.
It's a different market today for sure, and I would say there's 2 main reasons for that. The supply and demand dynamics are totally different today than they were in, let's call it, 06, 07, which leading into the Great Recession. We had too much of everything back then, really almost across all product types. And it was because money was cheap. They were building stuff like crazy. You had CMBS money to aggressive back-end loans that would get you out of construction loans. So there was a lot of stuff being done. Yeah. All right. Today, we don't see that misplacement of supply and demand. Yeah. All right. And that's a lot of that is because people have tempered themselves over the last few years. And that really harkens back to the Great Recession. Yeah. It seems like, as you mentioned before, an analyst who started his job in 2012, and he's seen 10 years of nothing but going like this, but 2008, 2009 is not that long ago.
Right.
So there's a lot of people in decision-making spots in commercial real estate that remember that pretty well.
Right.
And so you've seen in the last 10 years where prior to the Great Recession, everyone borrowed just about everything they could borrow, which means there were a lot of 75% loans, even in CMBS world, and there were some 80% loans done back then. You borrowed all the money someone would give you. Yeah. Coming out of the Great Recession, that was tempered, and to a lot of people, 65% became kind of the baseline, and occasionally even went under that. If you had the right equity, you have enough equity, I'll borrow less because it's safer to borrow less. Right. And I think the combination of those 2 things, that there's not as much debt on commercial real estate as there was back then in relative terms, and the fact that the supply and demand dynamics are more favorable today than they were before the Great Recession, those 2 things give me some confidence that this is clearly going to be a blip and a negative down period for us. I don't see it being remotely as bad as it was back then.
Yeah. And that kind of leads into the next question a lot of my listeners may have for you, Tom, is because some investors really look forward to down markets and seeing some distress. Do you expect some distress, and where do you expect to see it?
I really kind of expect that distress that gets to the point of distressed sales or foreclosures and resales, I really kind of think it's going to be minimal. And that goes back to why I think commercial real estate is in a much better spot today than it was in 2008. You will find some distress. I think like we did back then, I bet we overshoot it and we'll have hundreds of billions of dollars all at the starting line, getting ready to buy all this distressed stuff, and just like we did the last time, and it never really manifested itself. I suspect that'll be the case. I think you will have some distress in terms of certainly returns on your equity are going to be distressed. You will probably have some people that get in a situation where they might need a little help from their lender, minor workouts and stuff. I do not envision that we're going to have a tidal wave of foreclosures and resales and distressed portfolios selling at big, huge discounts like we've had before. I don't see that. And I guess it's a little bit of my personal view of it. I don't see that coming. Historically, recessions, the way they work, every other one has a negative impact on commercial real estate. 89, 90, 91, very, very bad. 2000, 2001, very minimal. Great Recession, very, very bad. This one, if we go on that historical scale, this one should have a moderate negative impact on commercial real estate, and I think that's going to be the way it works.
Yeah, well, I like that. I'll hang my hat on that one. I like that one. And when you again looking at the potential distress and the differences between the Great Recession and now. You also have replacement costs kind of enter into that as well, right?
Well, I mean, you've seen just based on inflation and what we've seen in the building business, and that goes even down to residential, where the consumer sees it's so much more expensive to do something in your home. Well, that's kind of even to a larger degree in commercial real estate. So replacement cost is so much higher than it was 24 months ago, 36 months ago, that your values in relation to replacement cost are going to be pretty solid, really. So I think there'll be reasons why people will stick it out, will keep their deals going. If they have to put a little more equity in to keep a deal alive, I think they'll do that because in the overall scheme of things, the valuation that they have that property at is going to be a pretty favorable valuation.
Yeah, I mean, it's amazing. I'm seeing some price per square foot on office. I lead a team that sells office buildings around the country, and we're seeing prices per square foot in some cases so low that you think about, well, if we go through a couple of years of lower demand, and then there's less new supply starts slacking off, and then the economy starts coming back, there might be some really good buys out there.
It's not an instantaneous thing because commercial real estate has such a lead time on it, but you will see the slowdown that we're in right now as far as new construction goes, which other than industrial and multifamily, very, very little being built right now. It takes a while for that to kick in, but there'll come a time there where all of a sudden we're going to hit a gap with that nothing is going to come out of the ground for a while, and that can really be kind of almost a positive thing in some ways, as it allows real estate to kind of reset and to kind of fix some of its issues with that, stabilize. You'll see occupancy stabilize a little bit. So that's not necessarily a negative thing, but we certainly are going to see a slowdown of commercial real estate deliveries to the market. I would say if you go out 12 months from now, 18 months from now, I think it'll be a noticeable slowdown.
Yeah. And part of that taking that long is because if there's a loan involved, right, the lenders view unfinished property as borderline valueless. The best case scenario for you to have the best possible resolution to your situation is to have that property completed. So even though right now you have an office building that's under construction, we've seen with COVID what happened with office.
you still have to finish it.
Right.
You know, you can't, you don't stop it halfway because it literally has no value at that point.
Right.
So the lenders will keep their stuff going. They'll stop new stuff, but anything in the pipeline right now, they're going to take it to the end and finish it. That's the only really way to do that.
Yeah, unless you're 100% equity, right? And
then you can make that decision.
Right.
I mean, you could slow it down and you could stop construction for 2 years if you're dealing with just steel and concrete. You know, you could let it sit there until the market gets better. Any deal with a loan on it, though, that's very unlikely to happen.
Yeah, makes sense. What's your expectations for rates moving forward?
I think we're getting near the top. Some of the stuff I've read recently has SOFR capping out in that like 475, 480 range around there. And I think it's now approaching the low fours right now, maybe 405 or so. So, you know, maybe we get another 75 basis points of SOFR growth there. The Treasury's really behaved fairly well recently. I mean, it was approaching. It was going to 4.5. It seemed not that long ago, and it's sitting recently down in the 380 range or so, where some spreads for some favorable property. There's some spreads that are really getting you loans now under 6. Certainly on the life insurance company side, and I think on the Fannie and Freddie side too. I think we probably still have some growth in the Treasury. I don't think I'd be really surprised if we saw a Treasury hit 5. I think, but it wouldn't surprise me if the Treasury went back up into the 4s or so. But I think we're closer to the end of this interest rate increase environment than we are to the beginning of it.
Yeah, I'll hang my hat, my coat. I'll think trousers, everything on that one there. In the office world I'm in, selling portfolios in office buildings, we're seeing a big surge in deals where we're doing CMBS assumptions. Mm-hmm. Are you seeing that? Any tips related to that?
CMBS assumptions are not easy.
No.
Okay, they can be done. Those loans are assumable. Your involvement of the master servicer and the special servicer in that process by nature is going to make it choppy and not real fast. So the seller needs to understand if their buyer is going to assume their CMBS loan, it's not likely to happen really quickly. It seems counterintuitive in that it might take longer to do an assumption than it takes to do a new loan, which would seem like that is counterintuitive. But you don't have the master and the special in that process involved in doing a new loan like you do on an assumption. Right. So be ready for that process to take a while. The assumability of debt right now is a value for people. Any loan made over the last 36 months or so is going to have such a favorable rate on it compared to the rates today for new deals that people will do anything they can do to try to assume that debt. Yeah. Where that hurts you is if that debt is too low in relation to the sales price.
Right.
If that debt, though, is getting up into the, say, 60% range or so of the sales price, I think they'll assume that debt and they'll bring equity to cover that gap because that debt is going to be way more favorable than anything you do today.
Yeah, we're certainly seeing that. And to your point, we've seen that as well where buyer and seller say, all right, we're going to do this. It's a CMBS assumption. Let's do this deal. We'll close it in 60 days.
Yeah.
I'm like, guys, you're going to close it.
Could be 160.
And we engage an expediter when we do it, right?
Yeah.
And that certainly helps.
There are some good companies out there that have made a living off of knowing how to work that process. Yeah. And if there's a time frame involved in it, it's probably a value to hire somebody like that to help you.
Yeah, absolutely. We require it in deals we're involved in. So if any of you guys want any referrals of expediters or any referrals for lenders or brokers or anything, feel free to reach out to me. And before I let you go, what tips would you leave our audience with related to their existing loans or new loans? Or
be happy that you probably have a pretty nice loan compared to the debt today. If you find yourself in a distressed situation, most distress starts out minor, and that can grow from there. But if you find yourself in that situation, be proactive, communicate. Don't let your lender know the first time they hear about your problem is when they don't receive a payment.
Right.
All right. That's never a good idea. And there's sort of an old theory that that's the way you get your lender's attention, is to stop paying. And I won't tell you that there's not some truth to that.
Right.
But be proactive. Get out there, call your lender, tell them what's going on, and how you plan to work through this. Right. Don't look to your lender to give you the solution. Bring the solution to your lender.
Yeah.
And get them to say, okay, that sounds good. Don't ask them, put your hands up. What am I going to do? No, you need to be the one that comes up with that plan. Yeah. But just be proactive and take a long approach to stuff. Don't make rash decisions on what may end up being a fairly short-term situation.
What if a listener has a maturity on a loan and they were at 3%? Now they got to pay, call it 7%. Yeah. Their debt coverage ratio is such that they've got to really reduce the loan to value. Is really the only remedy there is bringing cash, bringing an investor? Is there another source?
There's no magic bullet for that. Yeah. Depending on the financing you have, there may be mezzanine financing available to you possibly. There are so many lenders, though, that don't want mezzanine financing on top of their loans. Mm-hmm. That may be available. Maybe a preferred equity, which is kind of looks a little bit like mezzanine financing. That might be available to try to bridge that gap. But by and large, equity is what's going to solve your issues.
Yeah.
And that's unfortunately, that's just the reality of it. You may want to think one thing, and it may be available, it may not be available. But if you're maturing today, and you're of the belief that this is a temporary situation, and none of us really know that at all, but if you kind of have that feeling that this is temporary, you may want to consider floating rate debt on something where your rate today might be kind of ugly, really, but you can pay that loan off for nothing a year from now.
Yeah.
Versus closing into a long-term permanent loan that has a more favorable rate. But if you thought that I need to get out of this thing, you're kind of locked in with a long-term perm rate. So floating rate debt may be an answer there, but there's no secret formula to make that situation better than it is. Yeah. If you've been sitting on a 3.5% loan and you're rolling today to a new loan, that's going to be a painful change without a doubt.
Yeah, and your preferred equity, we have some sources for that, and we have also a source for some participation loans that may come in, and you give them a piece of the deal. It might be referred to as preferred equity as well.
And that's also a way too, if you're trying to do a workout with your lender. And once again, you believe this is temporary and you're going to get out of this situation, is you may trade for give them a piece of a deal.
Yeah, if they're that type of lender.
Yes, in order to get some concessions.
But some listeners may be in the situation where it's not temporary. They don't have a vacancy problem or a performance problem. It's just a higher rate. Just changes things, right? So either you pay it down, I guess, or bring in equity, or you sell the property. Since to your point, deals are selling. We have lots of independent office buildings and portfolios under contract in the process of closing. So there are a lot of buyers that like to buy in these markets. So you don't want to necessarily think your property's not sellable.
Oh no, no doubt. There's a lot of stuff that is still selling out there. There's a whole bunch of property that has been under bridge financing over the last 2 or 3 years, where there was some kind of transition, whether a renovation or retenanting, whatnot. And that property, that bridge loan is now coming due. Well, that bridge loan was underwritten on the assumption that the permanent loan was coming due was going to be 4, and now it might be 6 or 6.5. So that there's going to be some stress in that. Clearly, what's good about that is most of the bridge lenders are not in a heavily regulated environment, which will allow them to work with you. No lender wants to own a whole bunch of real estate.
Yeah.
So that's the last thing they want, really. So if they have the opportunity to try to work with you to get us over this hump into what we might think as a more stable market, if that's really coming, who knows? Then they may work with you on that. But that's clearly a segment of the market right now that you have to watch very carefully, because a lot of those loans are coming due now and in a totally different environment than was anticipated when they were made.
Yeah. And obviously there's some very strong markets where they're so strong that people are doing new developments and new construction still. Mm-hmm. Any sources out there for that?
Yeah, there's still some loans to be had. Construction financing right now is difficult. Mm-hmm. There are some people trying to take advantage of that market and looking to do construction lending kind of on a more national basis. That's generally a regional business. The banks right now, if you're not an existing customer of a bank and you walked in there with the most well thought out project you could imagine, you're still going to struggle mightily to get construction.
Tenant in place, everything.
Yes,
right?
Yes. Yeah. Banks will, in most markets like this, banks will take care of their best customers. Maybe a little lower loan to cost than you have gotten previously, but if you've got a feasible, well thought out project, you still might get some help from your bank, but it's got to be your bank. Yeah. It's not a deal where you shop it around to 10 different banks and find one. Yeah. This is where relationships mean a lot with the banks. So you got to go to your bank, make your best case there. That's going to be your best shot at financing.
Have a final thought for our audience as we get ready for the calendar to turn over to the new year?
Yeah, my expectation is there's not going to be much of a change from December to January, other than the fact that you're going to see some life insurance companies come back into the market, I think, in January. And they're actually already taking applications now for deals that will close in 2023. But I expect kind of steady as she goes with the rate market. Obviously, everyone's watching the Fed. Mm-hmm. We're seeing layoffs. The layoffs seem to be more geared into big tech that had kind of gotten bloated, and now they're kind of scaling down to probably where they should have been in the first place. We haven't seen layoffs on a large swath of companies, but that hopefully is some indication that the economy is slowing down. If we get the economy to slow down enough, we might get the Fed to back off of this trend they're in right now. That's kind of, I think, the salvation. It's when the Fed decides, okay, we're happy with the way things are. We don't need to mess with rates anymore. Yeah. Then everything will kind of settle in there, and hopefully you'll see some stuff back off a little bit rate-wise. But it will. I mean, the first fix of a problem interest rate environment is to stop them from going up. Right. Going down would be nice. Right. But the first thing is to stop them from going up.
Exactly.
And kind of, I think that's kind of our goal right now. Let's hit the ceiling on that, and then we can see if we start whittling down from there. But we got to hit the ceiling.
Perfect. Excellent. Well, great information, Tom. Thank you.
Okay. Thank you. Always a pleasure to be here.
All right. If you like more, reach out to Tom Walsh. He is with Grandbridge, and we'll have his information at CREshow.com. Thank you for joining us around the country. Happy Thanksgiving. Merry Christmas. Happy holidays. Happy New Year, and enjoy your holiday season. So until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, CREshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.